Welcome to another FAR walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over FAR Area 2, and this is Section B, and this is an application topic. Calculate trade receivables and allowances, such as credit losses and sales returns, and prepare journal entries. And we're going to be doing that the SuperfastCPA way, which is diving straight into questions to learn the material. If you don't know much about our strategies, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour, and we will teach you the key ingredients to passing the CPA exam, some of them being studying in the morning for 2 hours, making sure you review every day, and of course, diving into the questions first, because what are you going to be doing on test day? You're going to be answering multiple choice questions and sims. You're not going to need to know how to watch a lecture perfectly or how to read through a textbook. You need to know how to answer questions. So that's the best way to learn. On that note, just letting you know, we will only be going over 5 questions in today's video, whereas SuperfastCPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other videos and our other products, make sure you go check out the webinar and make sure you become a Pro member because you will get access to the full videos and a lot of our other resources. Now, with all that said, let's dive straight into the questions. All right, here we are at question 1. Something that's always good to do is to read the last portion of the question to kind of give yourself context. It doesn't always give you the best context, but a lot of times it lets you know, hey, I need to be looking for this as I read through the question. So we always recommend starting with that. If the beginning balance of the allowance for doubtful accounts is $3,000, what is the amount of bad debt expense recorded for the period? Okay, so we need to figure out the bad debt expense, but we have to read through the rest of this. Bright Solutions, Inc. uses the aging receivables method to estimate its bad debt expense at the end of each period. The following is a summary of its accounts receivable by age, along with the estimated percentage of uncollectible accounts. Okay, so they have 0 to 30, 31 to 60, 61 to 90, and over 90. This is how long the receivables have been sitting there without having been received. So for the 0 to 30, we have 200,000. For the 31 to 60, we have 150,000. For the 61 to 90, we have 80,000. And for over 90 days, we have $50,000. And each of these has an estimated uncollectible percentage. So with this information, and again, remembering the last part here, where the beginning of the allowance for doubtful accounts is $3,000, we have to figure out the bad debt expense. Now, if you have no idea how to do this, that's okay. That's the point of diving into the questions is you're not going to know how to do it most of the time, but you're going to learn how to do it from the question. If you know how to do this, that's great. Pause the video and do it. If not, let's go ahead and dive into it to see how this works. All right, here we are. The answer is A, $16,600. So that is the amount of bad debt expense that we have to record. Now, what does that even mean? Let's walk through this to kind of understand what's going on. So the bad debt expense is calculated by multiplying the total amount of each age group by its respective percentage and summing up the results. So that's how we start. So we take this $200,000, multiply it by 1%. And again, this is for the aging receivables method. It's likely you'll see this in your study course or or maybe even on the test. So again, multiply 200,000 by 1%, that gives you 2,000. Multiply the 150,000 by 3%, that gives you 4,500. Multiply the 80,000 by 7%, that gives you 5,600. And multiply the 50,000 by 15%, and that gives you 7,500. And you'll notice that as the days go on longer, the percentage likelihood of it being uncollectible increases, which makes sense because the longer you're sitting around waiting for somebody to pay you, the less likely it is that they're actually going to ever pay you. So we see that there, we add all that up together, that is the total estimated uncollectible amount. So that's how much we're guessing based on all of these different receivables and how long they've been sitting there. That's how much we're estimating is going to be uncollectible. And that of course has to do with the allowance for doubtful accounts and bad debt. Since the beginning balance of the allowance for doubtful accounts is already $3,000, the bad debt expense for the period is the required allowance, which is what we calculated up here. So we think that we have to have at least $19,600 in the allowance for doubtful accounts for any bad debt. Since we already have $3,000, to increase it to the $19,600, we have to have a bad debt expense of $16,600 because bad debt expense increases the allowance for doubtful accounts. So the way we figured that out, again, that's taking the required allowance that we figured out from up here, subtracting the already existing allowance, and that gives us the bad debt expense that's needed to get up to the correct allowance for doubtful accounts that we calculated up here. Now, this is one of the methods that you can do all this, the aging receivables method. This is a technique used to estimate bad debt expense by categorizing accounts receivable based on the length of time they have been outstanding. So this is one way you can figure out or estimate the allowance for doubtful accounts is by seeing how long all these receivables have been sitting there. Each category is assigned an estimated percentage of uncollectability, with older receivables typically having higher percentages to calculate the total amount expected to be uncollectible. So this is one way that you can calculate the bad debt expense. By the way, this is a large focus of this topic. At the beginning, it's like calculate trade receivables and credit losses and sales returns. And what that seems to mean, based on learning from the questions, is it's a big focus on the different methods for calculating allowance for doubtful accounts and bad debt. So that's what we're going to dive into for a lot of the questions. Let's go to the next question to see if there's another method. All right, here we are at question 2. As always, read the last part. What is the journal entry Franklin Industries should record to write off the account? Okay, so this is a journal entry question. On December 31st, Franklin Industries decided to write off a $5,000 account from XYZ Corp., which was deemed uncollectible. That makes sense why they wrote it off. The company uses the allowance method to account for bad debts. Before the write-off, the balance in the allowance for doubtful accounts was $12,000. What is the journal entry Franklin Industries should record to write off the account? Okay, so they're using the write-off method, and so they're writing off this receivable that they don't think is going to be collected. What is the journal entry for that? So if you have an idea, that's great. You probably can look at this without even having to pause the video and know the answer. If you don't know how to do this, that's okay. We're going to dive straight into the answer to learn what the journal entries is in this case. All right, here we are. The answer is B. For this journal entry, you would debit the allowance for doubtful accounts, and you would credit the accounts receivable for the amount that was written off. So that's what you do. That is the journal entry when you're using the write-off method. When you do a write-off, this is the journal entry. So let's dive into the explanation. When using the allowance method, writing off an account reduces the allowance for doubtful accounts, which is the debit, and removes the specific accounts receivable, which is a credit, from the books. And when I say that, I'm not saying that accounts receivable is a credit account. I'm saying to reduce accounts receivable, you credit accounts receivable. This does not affect bad debt expense, as the expense was already recorded when the allowance was initially set up. Because bad debt, you might think of it might be kind of weird to think about it this way, but allowance for doubtful accounts, remember, is a contra asset account. So allowance for doubtful accounts is actually a credit. It's considered an asset, but it's a credit. So to increase it, we have to credit allowance for doubtful accounts and debit bad debt expense, or that's one of the ways to increase allowance for doubtful accounts. Whereas to decrease allowance for doubtful accounts, we have to debit it because, again, it's a contra asset account. So instead of debiting it to increase it, we credit it to increase it. So to decrease it, we debit it. And then the other side of that is reducing the accounts receivable because you don't think you're going to receive that money. So this is one of the basic journal entries for this whole process for allowance for doubtful accounts and bad debt and things like that. Now let's go to the next question. All right, here we are at question 3. What is the bad debt expense that should be recorded for the year? Okay, we have to figure out bad debt expense. Let's read the information. At the beginning of the year, Evergreen Manufacturing had an allowance for doubtful accounts balance of $6,000. During the year, $2,000 of accounts were written off and $1,500 of previously written off accounts were recovered. So they had written off these accounts where they're like, we're never going to receive that money, but turns out they did actually receive the money. So that's why it's called a recovered account. The total accounts receivable at year end was $80,000. Based on the aging receivables method, the company estimates that the net receivable or net realizable value of accounts receivable should be $74,000. Okay, so we're seeing kind of a mixture of some things that we've talked about so far. So with that information, we have to figure out what the bad debt expense is. Again, if you have any experience in this or you've done it for work, you probably know how to do this. So go ahead and pause the video and do the calculation. If not, if this is something new or fresh to you, that's okay. We're going to dive straight into the answer to learn how this works. All right, here we are. The answer is D, $500 is going to be the bad debt expense. So we need to figure out how to get to that. So when you have these situations where you're given, some accounts receivable, some of the things that were written off and some of the things that were covered and things like that, there's certain steps that you have to do. So in this case, because we know that the ending accounts receivable was $80,000, so that's an important number. But we were also told that the net realizable value based off of the aging receivables method was actually $74,000. Now what that means is that based off of the aging receivables method, this is how much we're actually expecting to get. So this is how much we're expecting to get. This is how much we have as a receivable. So if we take the ending receivable and subtract the net realizable value that we're expecting to get, that gives us the ending allowance. That gives us the allowance for doubtful accounts that we need to end with because we think that we're not going to get $6,000 of these accounts receivable. So that's what you start with. If you're ever given the ending accounts receivable and the net realizable value based off of maybe the aging receivables method or something like that. You need to use that to figure out what the ending allowance should be. So now that we know what the ending allowance for doubtful accounts should be, which is $6,000, we can then do the rest. So we go down here, we take the beginning allowance for doubtful accounts that was at the beginning of the year, that's $6,000. We subtract the accounts that were written off because, again, we think that we're not going to receive those. We add back the accounts that were recovered because turns out we did get that money. So we kind of reverse this accounts written off here. So we end with the allowance before we've had to do any bad debt expense, before we've done anything, of $5,500. So this is what the allowance for doubtful accounts is at the end of the year before doing anything else. But now that we've figured out what the ending allowance should be based off of the net realizable value and our ending receivables, we then go down here, we take the required ending allowance, which again we figured out up here, we subtract the current balance, and that tells us how much we need to have as a bad debt expense to get from the $5,500 that we're currently at for the allowance for doubtful accounts up to what we think we need, which is the $6,000. So the bad debt expense in this case is $500 to get up to the $6,000 that we think is required to have in the allowance for doubtful accounts. So basically the idea behind this is we're trying to figure out what we need supposedly at the end of the year for the allowance for doubtful accounts, and then we take the information that we're given for what happened throughout the year and use that to figure out what the allowance for doubtful accounts is right now before we've done anything else, before we've done any adjustments, and that will let us know how much we need to have as a bad debt expense to get up to what we think is required. So it kind of looks like a lot, but it's really not too bad once you understand what each part of the process is. Let's go to the next question to learn a little bit more. All right, here we are at question 4. As always, read the last little part there. What is the bad debt expense for the year? Okay, again, we need to know the bad debt expense. Baker Industries started the year with accounts receivable of $240,000 and an allowance for doubtful accounts of $18,000. During the year, the company wrote off $7,200 of uncollectible accounts. At the end of the year, the accounts receivable balance was $260,000 and the allowance for doubtful accounts was adjusted to $19,600. What is the bad debt expense for the year? Okay, so based off of this information that we're given, we again have to calculate the bad debt expense, but this is a little bit different than what we've seen so far. If you have an idea just based off of what we've done, that's great. Pause the video and do the calculation. If not, again, we're going to dive straight into it to learn how this works. All right, here we are at the answer. The answer is A, $8,800 is the bad debt expense. So again, this is the expense that we have to increase the allowance for doubtful accounts to what it's supposed to be, which is this $19,600 at the end of the year. So let's walk through this. This is kind of like the general idea. You can kind of use this in a whole bunch of different situations and just slightly change it. You start with the beginning allowance. We don't know what the bad debt expense is, so that's blank right now. You subtract the accounts written off, and then we somehow ended up with the allowance for doubtful accounts of $19,600. So somehow from $18,000 less $7,200, we get to $19,600. So there's obviously a plug there. You can do it one of two ways. You can either take the $18,000, subtract the $7,200, and then subtract that amount from the $19,600. Or you can just start with the $19,600, the ending, add the amount written off, subtract the beginning, and that will give you the bad debt expense. That will give you the plug. Because let's walk through this. So $18,000 less $7,200, that is $10,800, right? So we are at $10,800 in the allowance for doubtful accounts, but then it somehow ended up at $19,600. So we can either take $19,600 and subtract $10,800, and that gets us $8,800, or we can just start right away with the $19,600. We add back the accounts written off, so that would be $26,800, and then we subtract the $18,000, and that gets us to $8,800. So you can kind of do it however makes the most sense to you, but essentially this bad debt expense is a plug in this situation. You are given the information that you need, and you just need to figure out what the bad debt expense was to be able to get to the ending amount. Now for this case, we didn't need to know the accounts receivable balance because again, we had the ending allowance for doubtful accounts already. So we didn't need this to figure out what the ending balance should be because we were already given what it was going to be. So in this case, the accounts receivable balances weren't necessary. That's really only necessary if you can use the ending accounts receivable and the net realizable value to figure out what you need the allowance for doubtful accounts to be. So a little bit different situation this time. Now let's go to the next question. All right, here we are at question 5. What is the net sales revenue that Jackson Electronics should report? Okay, so this is very different than what we've seen so far. We've been dealing a lot with bad debt expense and allowance for doubtful accounts most of the time. Let's read through this. Jackson Electronics recorded total sales of $520,000 during the month. The company estimates that 6% of these sales will be returned by customers within the 30-day return period. So they have a 30-day return period. They're guessing that 6% of the sales will be returned. So what's the net sales revenue? Just based off this, I think you can easily figure this out. Go ahead and pause the video, do the calculation, and when you're ready, come back. We'll look at it together. All right, here we are at the answer. The answer is A, $488,800 is the net sales. This is a very straightforward concept for this topic, for the trade receivables and things like that. When it comes to the sales returns that you're expecting, it's really simple. You just take the sales that you had, you multiply it by the expected sales return rate of, in this case, 6%, and you multiply the sales by that expected return rate, and that gives you $31,200 in this case. You take that, you subtract it from the total sales, and that gives you $488,800 of the net sales revenue. So this is how much they are recording because they are expecting 6% of the sales that they had to be returned. So if that's wrong, that's great. They'll make an adjustment for that. But this is what they would do at the beginning. They would record net sales of $488,800. A sales return allowance is an estimate of the amount of sales that a company expects to be returned by customers. Pretty straightforward. It reduces the reported revenue to reflect the net amount of sales the company realistically expects to keep, providing a more accurate picture of revenue after considering potential returns. So this is kind of a one-off question. It's kind of a smaller topic, it seems, for this blueprint topic, knowing how to do sales returns for these allowances and for these receivables. But it is important to at least have one question, at least know how to do it. So we've gone over a lot. In just 5 questions, we've learned a lot about this topic. Before we go any further, let's do one more part of the process called pillar topics. Now, the idea behind pillar topics with SuperfastCPA is as you're going through the questions, you will notice the things that keep popping up. You've seen 3 questions trying to teach you how to calculate the bad debt expense plug when you're given the beginning allowance and the ending allowance and the write-offs and things like that. Or you've seen 4 questions trying to teach you about a different aspect of that, or whatever the case may be. You will notice the things that keep popping up in the questions that you're obviously supposed to know. So you take a moment, you write these pillar topics in your own words, kind of as a summary of the most important things you learned from doing the questions and what you obviously need to know. And as you do this throughout your process, you will slowly build the pillar topics that you need to know for the whole exam. So let's go ahead and look at the pillar topics for this video. All right, here we are at the pillar topics. Now let's go ahead and dive straight into them. The allowance for doubtful accounts and bad debt. So that was kind of the whole focus of this video. Just a reminder, to calculate bad debt expense, this is one of the ways you can do it. You can take the required ending allowance, and we'll talk about that in a second, less the beginning allowance, less the accounts written off, plus the accounts recovered. That's one of the ways you can do this, and that will give you the bad debt expense. Now, what is the required ending allowance? That's something that you might have to figure out so that you can figure out what the bad debt expense is. The required ending allowance is typically determined based on the percentage of receivables being deemed uncollectible using methods like the aging receivables method, or maybe you'll even be given the accounts receivable at the end of the year and the percentage that they're expecting to not receive. So that would be the allowance for doubtful accounts at the end of the year. You might have to do different things like that to figure out the required ending allowance. You may also have to, I just realized that I double had that. Sorry, I fixed that. You may have to subtract the net receivables from the aging receivables method from the ending accounts receivable. So what I mean by that is, if you remember in one of the questions, the aging receivables method said that the net receivables is going to be this, but then we were also giving the actual ending accounts receivable. So if we take the accounts receivable that there is at the end of the year and subtract the net receivable value, that will tell us how much the allowance for doubtful accounts needs to be at the end of the year. So you'll need to know the required ending allowance, and sometimes it's given to you. Sometimes you have to figure it out based off of these calculations, and that will help you figure out the bad debt expense. The journal entry for writing off using the allowance method. So if we are doing a write-off, this would be the journal entry: debit allowance for doubtful accounts and credit accounts receivable. Remember, you're not debiting bad debt expense in this case. When you're writing something off, you're debiting allowance for doubtful accounts and crediting accounts receivable. Now, bad debt expense as a plug figure, again, this is a different way that you can calculate the bad debt expense. You can just take the whole equation that there typically is, which would be the beginning allowance plus the bad debt expense, which you probably don't know, less the accounts written off plus the accounts recovered, and that will equal the ending allowance. And you can use this to move things around and to figure out what the plug is, what the bad debt expense has to be to get to that ending allowance based off of the other information. And basically, I just said this, you have to solve for bad debt expense as the unknown value, so you kind of have to use that as a plug. And then finally, the net sales revenue with returns allowance. That was kind of the last thing we covered, and this one's pretty easy. Just remember that net sales, when it comes to having those expected returns, is just the total sales less the total sales multiplied by the estimated return rate. And you don't need to, and by the way, just in case you see this, I didn't talk about this in the question, but I just want to let you know, if you see anything about prior period stuff, that doesn't have to come into account because, again, it's focusing on the sales for that specific period. You don't have to focus on the returns from the previous period. So with that, those are the pillar topics, and that is the end of the video. Before you go, make sure you check out our free 1-hour webinar training on SuperfastCPA.com. Again, it's only 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. Strategies like studying in the morning, making sure you review every day, diving straight into the questions, things like that, and more, we will teach you in the Superfast CPA training webinar. So make sure you go check that out. Also, just a reminder, we only went over 5 questions in today's video, whereas Superfast CPA Pro members will have access to the full 10-question video when we post it in the members forum. So if you like this and you like our other material, make sure to become a Superfast CPA Pro member, and you will get access to a lot of other resources that can really help you through the exam. So make sure you check that out as well. If you liked the video, make sure to like it and leave a comment. I hope this was helpful, and I will see you in the next video.